Hi everyone, welcome to this session. In this session, the main objective of this session is to discuss the financial crisis. So we will be discussing what contributes to financial crisis. Before I lay down the objective of this session, let me see what is a financial crisis. So you might have heard that 2007-8 financial crisis, and it is considered as said as once in a credit century credit tsunami. This is the 2007-8-9 crisis. The other one crisis in 2019-29. This crisis was considered as the mothers of all financial crises, which then led to the Great Depression of 1929 to lasting for nearly 1 decade. So this one is also one of the biggest financial crisis, and we are more familiar with the recent one, that is the 2007-8 financial crisis. So let us give a proper definition of what is financial crisis means. So a financial crisis occurs when there is a particularly large disruption to the information flows in financial markets, with the result that financial frictions increase sharply, and ultimately financial markets stop functioning. That is, a financial crisis is any of a broad variety of situations in which some financial assets suddenly lose a large part of their nominal value, and is often triggered by a panic or a run on banks. So now we are going to discuss what are the factors affecting financial crisis, and through from an economic lens. That will be the main focus of this session, and in the subsequent session we will present all these factors whatever we discuss in this session, whatever we have discussed in the previous sessions, that may especially in the asymmetric information context, and we will be bringing everything together and will be presenting these aspects in theoretical framework to understand the dynamics of financial crisis. Then subsequent session we will be applying this framework to understand the 2007-8 crisis, and also we will be discussing the same framework to understand the financial crisis in some other emerging economies. So let us now focus on the first part, that is the factors affecting financial crisis. So we will list out various factors that affect, then we will discuss each of them in detail. So more importantly, the discussion will be confined to from an economic perspective, and what are the theoretical pathway through which this can affect. But actually when we do this theoretical perspective, when we apply in the empirical part, it's not necessary that each of them is going to work the way we expect. There will be so many counter factors in the actual economy, because the real economy is a more dynamic and very complex one. Several factors they will be working in both directions. So let us start why financial crisis occur. So factors playing important roles in financial crisis are mostly the theoretical aspects. So our focus will be here, these factors, how they worsening the effects of the asymmetric information problem, how these factors, the factors that we are discussing here, we see how these factors worsen the effects of the asymmetric problem in the financial market, then how come it lead to the collapse of the market. That means nothing but the financial crisis. So there are several factors, so we will be listing out this one by one. So the first one, we will be discussing total 6 factors, and let us start. The first one is asset market effects. So of these asset market effects, there are 4 related aspects. One is called stock market decline, and second one is what if there is a stock market decline. That you can see that any of these, whatever the factors that we are discussing, it all can, either of these one, if it is more powerful or considerable, then it can really lead to financial crisis. So then within asset market effect, we are first seeing stock market decline. If there is a stock market crash, the collapse of the stock market, then we will see that how that would lead to financial crisis. Then another thing is unanticipated decline in the price level, and the third thing is unanticipated decline in the value of domestic currency, that is depreciation, that is if it's unanticipated. Then the third last one is asset write downs, especially if there are lots of non performing assets. So let us discuss one by one in the asset market effects framework. The first one is the stock market's decline. So what would happen if there is collapse in the stock market, if there is a stock market crash? So you know that maybe see that if most firms stock price decline, so that means there is lead to deterioration in borrowing firms balance sheet, right. So one of the previous class we have seen that the net worth is equal to assets minus liabilities. Then you can see that if their assets, actually the assets is price decline. So what if happen that if their stock price declines, then obviously you know that when their stock price declines, there will be decline in their net worth. When they decline in their net worth, and because share prices are the valuation of a corporation's net worth, that means the assets, this will be declining. So as a result, when the asset price decline, then you know that the net worth of the company also declines. So when the net worth of the company declines, what are the effects of the decline in net worth? Let us recall whatever we have studied in the previous sessions. When there is a decline in the net worth of a company, we know that this will trigger out the adverse selection and moral hazard problems. So you can see that if the company's stock price decline, when the company's net worth declines, then there will be less lending to those institutions, right, because lenders are now less protected against adverse selection. So because of that, you can see that when the lenders are less protected against adverse selection, these firms, because if it is a stock market crash, that means most firms their net worth is low, that means most lenders, they will be reluctant to lend. As a result, the capital flow get affected from the, that means from the surplus sector to the deficit sector. There will be less incentive for the households and institutional investors to lend in the market, because they see that there is increased risk of default. In the bond market they won't invest, and even they won't invest in the company's IPO. So as a result, when we see low investment eventually leads to low GDP and low employment. So that means here itself you can see that this will be worsening the financial crisis, creating financial crisis, that is stop the functioning. That means low investment, low lending means is actually worse, in a way leading to the stopping of the functioning of the financial market. Similarly, we also seen that low net worth, it actually promotes moral hazard behavior, right. So we have seen that there will be moral hazard behavior because there is low net worth. That means there is little bit, only very little, nothing to lose for. If the company's net worth is very low, company obviously they think that, the promoters think that, the management thinks that if they engage in risky activities, that means if it give them a lump sum profit, a huge profit, then obviously the company is going to benefit. If they lose, it's actually the public money, the borrowed money, right. That means the moral hazard, the low net worth, because of the decline in stock price, which is leading to low net worth, it will promote moral hazard behavior, and the firms will be undertaking more risky investment. Moving to second aspect, that is unanticipated decline in the price level. So if there is an unanticipated decline in the price level, so let's see, for example, deflation. So if it is an anticipated, obviously you know that market will be prepared accordingly. If the decline in the price level is unanticipated, then you see how is going to affect the interest rate. So normally most of the interest rate will be fixed interest rate, not the flexible one, and also fixed in nominal terms. So what is going to happen? Suppose if the asset market effects, as a result, you know that if there is a effects of deflation, the debt contracts, you know that how does it affect the interest rate. interest rate is actually 5. For example, this one is already agreed interest rate for the next, suppose we say that rate of interest is 5%. This is already agreed for next 20 years. If there is a deflation, then you know that they have to anyway pay 5% itself, but you know that because of deflation the value of money has increased, right? So they will be still paying 5%, but the in real terms this 5% may be equal to 10%, or we can say that it may be 15% or 20%, right? 20% like that. So what we can see from here is that debt servicing, that is the interest payment, that burden increases if there is deflation, right? So that means instead of that 5%, that agreed that one is the nominal 5%, but they will be still paying 5%, but in real terms is going to be much greater than this 5%. That means their debt servicing, the payment, interest payment, it increases. This is nothing but their liability is going to increase, right? In the net worth we always seen that the assets minus liability. So because of the increase in the debt, that is interest payment burden, real burden, increase in the real burden of interest payment, also because where then the liability side increase, then obviously you know that the net worth is going to decline. So this leads to decline in net worth because of the increase in the burden of debt. So that means increase in value firms borrowing liabilities. So this would lead to again make this firm vulnerable to adverse selection and moral hazard problems. So this would lead to again the point that we discussed, that net worth is decline in net worth, it leads to the worsening the asymmetric information problem, adverse selection problem, the way we discussed in the previous session. That means there will be less lending, and it also encourage incentivize the banks or the financial institutions or any institution, who are the firm who have borrowed it, for them to engage in risky activities. Then the third one is under the asset market effects. This one is unanticipated decline in the value of domestic currency. Many firms, they issue debt denominated in foreign currency. Then what would happen? Suppose a company in India, a firm in India, they issued corporate commercial paper and they have borrowed from abroad, that is from dollar. They borrowed from in dollar, and obviously they have to repay their debt and interest income in terms of dollar. What if there is an unanticipated decline in foreign exchange rate of domestic currency? Suppose at the time of borrowing, suppose it was $1 was equal to, for example, $1, the exchange rate was 70 rupees. What if there is the decline in the value of domestic currency? What if it becomes $1 becomes 100 rupees? So in this case, you know that when there is an unanticipated decline in the value of domestic currency, now when they make the repayment, both principal and interest income, they have to pay more, right? So they taken, for example, they have taken 1 million when the exchange rate was this one. Now when they are paying, when the exchange rate was 70, now when the suppose the due to depreciation it became 100 rupees you need to pay to get $1. That means when the repayment time they need to pay more. That means to get $1 you need to spend 100 rupees, right? So in this way the debt burden, again we can see that because of this the debt burden of firms increase. The debt burden of firms increase here, and as a result again we can say that this is nothing but firms liabilities will be increasing. When firms liabilities increasing, we know that clearly the net worth of the bank is declining. So this again through the asset market effect we can see that the problem of adverse selection leads to adverse selection and moral hazard problem. So the point whichever we discussed in a couple of minutes before, we have been discussing. So that point is relevant here as well. That means decline in net worth, it makes the firms, the borrowed firms, more vulnerable to adverse selection and moral hazard. And you can see that the issue of unanticipated decline in value of domestic currency, as well as the previous one, the unanticipated decline in the price level, both is actually a macroeconomic risk, a systematic risk that affecting most of the firm, and as a result, if the most of the firms who borrowed from the market and if most of the firms net worth decline, then you know that that would lead to hampering or affecting the flow of funds or the lending funds into the market, and as a result overall the smooth functioning of the financial market get disrupted, and as a result it will start stopping the market, and ultimately we can see that a kind of financial crisis happen. Then one more thing that is coming under this asset market effect is the asset write downs. Here in this case, what if the more and more non-performing assets are in firm's balance sheet. So it's an accounting term, asset write downs. This one is an accounting term used to describe a reduction in the book value of an asset due to economic or fundamental change in the asset. So for example, illiquid investments such as real estate and banks non-performing assets, and you know that if there are, for example in the case of banks, if there is non-performing assets in the bank for more than 1 year, so after a certain point of time they have to take it out, they have to write down this from the balance sheet. So obviously you know that our framework that the NW that asset minus liabilities, when illiquid assets, investments such as real estate and banks NPAs written down, write downs happen, then obviously the assets will be declining. That is nothing but assets declining, then the you know that the net worth of the bank also will be declining. So when banks make that the write downs can be caused by the either negative change in the overall macroeconomic environment or microeconomic occurrence such as building deteriorations, etc. So as a result the decline in net worth, and we have seen that decline in net worth leads to the problem that we mentioned. That means it worsens, it aggravates the asymmetric information problem, and as a result you can see that adverse selection and moral hazard problem get worse, and as a result the smooth flow of fund from the surplus sector to the needy sector it get disrupted. That coming to the second one, this one is increase in interest rate in the market. What if there is increase in interest rate in the market, and how does it will lead to financial crisis? So if increase in interest rate is due to increased demand for credit or shortage of funds due to decline in money supply, then what would happen? So suppose it happen that there is increased demand for credit or shortage of funds due to decline in money supply. So you know that mainly interest rate increase will be happening either due to increase in demand or keeping money supply constant, or increase in demand remain constant and there is decline in money supply. So both actually would lead to increase in interest rate. So let us see what if the market rate of interest rate increases. So who is willing to pay highest interest rate? About the supplier of bonds, among the supplier of bonds, that is firms. So you can see that firms or individuals and firms with the riskiest investment, they actually will be willing to pay more. That is nothing but we can see that firms with high default risk or poor ratings, that means high risk firms are willing to pay highest interest rate in the market. At the same time, we already know that when the market rate of interest increases, firms with good credit risk are less likely to borrow, and obviously bad risk are still willing to borrow. So obviously what is going to happen? Apparently you can see that the market will be overrepresented by high risk or individuals and firms, borrowers, high risk borrowers, and then that would obviously, you know that we already studied, that means it will lead to the problem of adverse selection issue, right? Because the market will be more with high risk borrowers, and even in the long term we can see that they won't be paying back. They will be making default risk, and as a result in the market the lenders will be reluctant to lend in the coming days. Not only that, even the adverse selection itself, we find that if this kind of scenario happen, if there is an increase in interest rate, if it's increase in interest rate, firms of good credit risk will back out, and if only bad risk firms are only in the market, then obviously the lenders, they also get the signal that the market consists of only high risk firms, so eventually they also stop lending in the market. Then if the increase in interest rate, we also see that this would reduce the cash flow of the firms, because you know that the liability of the firms, the borrowed firms are increasing. So that means the cost of borrowing is increasing. So the cash flow, that is the difference between cash receipts and expenditure, so there will be less internal finance for this firm because of the interest rate increases, the cost of borrowing increases, so they have to rely on external finance, and then again you know that this is again subject to asymmetric information. So in the one of the previous session also we have seen that because of the asymmetric information, more firms, you can see that empirically we have seen looking at the figure, that means internal finance is becoming the main source of borrowing for many firms because of asymmetric information. But if the interest rate increase, that means already most firms already they will be having some debt burden anyways, so debt burden will be there. If there is increase in interest rate, actually their cash flow declines, so as a result they have to depend on external finance. But again, because the internal finance will be getting affected because of the reduction in the cash flow, and they will be subject to more asymmetric information, and again they have to depend on external finance, and which is again subject to adverse selection and moral hazard problem. And third factor, that one affecting financial crisis, that could possibly lead to financial crisis, is a deterioration in financial balance sheet. What if financial institutions, particularly banks, when their balance sheet deteriorate to some reasons, maybe because of the systemic, or that is the idiosyncratic or systematic risk, maybe because of either of these, for example, or all of them, for example. For instance, what if the balance sheet deteriorates? So suppose particularly of banks, financial institutions balance sheet, and you know that banks they play major role in financial market because they are well positioned to engage in information production. So we have seen that banking industry, they are well positioned to engage in information production, collection of information, then the production, and using this information for their own business, and so that there won't be any free rider problem. So they will be using it for their own information, that is to their own business, that is to provide private loan. So actually these banks, they channelize capital to productive investment. You know that since banks are having this comparative advantage, the households who is not well versed with the financial market, they will be mostly preferring the banking system. That the households and low profile households, individual investors, they will be preferring banking system as to park their money, right, to deposit their surplus. So that the banks, they are collecting this money, then they are transferring this money, these funds, to the different sectors of the economy where these are mostly needed. That means they make it for productive investment. What if due to some reason which I mentioned already, the bank's balance sheet deteriorate? That means as if their bank balance sheet deteriorate, their lending will come down. So if there is a banking crisis erupt because of this bank's balance sheet deteriorate, then obviously you know that banking crisis erupt, and there maybe you can see by bank balance sheet deteriorate, maybe there will be lots of NPAs, non-performing assets. So then their lending will come down, and this will slow down in economic activities. And because banks have been acting, they act as one of the key intermediary, a financial intermediary, that is collecting money from those who are having surplus and channelizing this fund to the sectors where it can be made more productive use. So that will lead to deterioration, that will lead to financial crisis. That means stopping the flow of funds from the surplus sector to needy or deficit sector. And fourth one, this is a little bit related to the issue that we discussed, that the deterioration in the bank's balance sheet. We can see that what if there is a banking crisis, what if some banks fail, if there is some banking crisis happen, if the deterioration in the banking crisis, bank's balance sheet is severe, then you know that they start failing. So again we have seen that means if there is a rumor that actually some banks are not paying back their deposit, then the depositors will be running to the bank run will happen. You know that deposit can be pulled out quickly, but at the same time you know that all these funds are already been distributed already in the market, in the loanable fund market, and so that bank cannot pull it back, bank cannot call back all the loans. So we have seen that deposits are more liquid, but bank loans are less liquid, right? It cannot be called back. So this would lead to a bank panic. It will lead to a bank panic. So that means if one bank fails, and then because of the asymmetric information problem, multiple banks fail simultaneously as withdrawal of deposit leading to bank failure. So we have seen that even a good bank, they also won't be able to pay back deposit if all the depositors turn to the counter collectively. That means everyone come to the bank. If bank run, the pace of bank run increases, that means bank panic. Because of bank panic, then multiple banks fail simultaneously. So this fear can spread to from one institution to another. So we already seen sources of contagion is the asymmetric information. So everyone, because of this issue, that means this also point we discussed that the depositors case, because the fearing of the safety of their deposit, because they don't know the quality of bank's loan portfolio. So as a result there will be bank failure. Then another related fact is what if there is increase in uncertainty in the market, because one of the principle that we discussed in the beginning of this course, that means uncertainty reduces welfare. So for the welfare of the economy, we prefer to have more certainty in the economy. What if there is increase in uncertainty? Increase in uncertainty about interest rate, about the inflation, about the economic conditions or political conditions, all these things. If there is an increase in uncertainty, dramatic increase in uncertainty in financial market due to bank failure or stock market crash or war or any factors that would lead to increase in uncertainty. Then as a result, you know that there is asymmetric information, then resulting in inability for lenders to distinguish good credit risk and bad credit risk, and as a result there will be less protection from adverse selection for the potential investors, and they will be less willing to lend and low investment and then low GDP. So the factors that we discuss here, we discuss 5 major aspects that would lead to financial crisis, and the next one which we need more time to discuss, that the government fiscal imbalances, that we will discuss in the next session. Thank you. See you in the next session.